This is the Coins, Cashflow, and Conversations podcast, sponsored by Upstate Essential Solutions. If you need help with your personal and business finances, contact me today at dakotagrady.com. Hey y'all, welcome to the podcast. So today we're going to dive right into the conversation, talking about why an IUL, that is an Indexed Universal Life Insurance policy, is a bad buy. Here is what that is. So an Indexed Universal Life Insurance policy is a type of permanent or whole life insurance that provides a cash value component along with a death benefit. The money in a policyholder's cash value account can earn interest by tracking a stock market index selected by the insurer, such as the NASDAQ 100 or Standard & Poor's or S&P 500. You can also have a fixed rate account on that particular policy as well. Although the interest rate derived from the equity index account can fluctuate, the policy does offer an interest rate guarantee which limits your losses. It also may cap your gains. All right, so let's break that down. So an IUL is a whole life insurance policy. It's simple, right? And it has a cash value component that earns interest based on a stock market index, such as S&P 500. And it has a cap, say maybe 3% cap you would get percent. And usually the cap is between 8 and 12%, but I'm gonna use 6% in this example. So you're investing or you bought this IUL and say you have $10,000 in your account, cash value. Well, you got 6% as your cap, and then you also have 3% as your floor, right? I didn't also mention that you have what is called a participation rate, which the insurance company sets. So you do 6% for your gain, $10,000 in your cash account, and then you have the 50%, for example, for the participation rate. Now that participation rate can be between 25% and 100%. And again, the insurance company, they set a particular rate. So you're going to get 6% for your gains times $10,000, right? Which is the balance in your cash account. But then you're also going to have to multiply that by 50%, which is the participation rate. So you won't be receiving $600 for the gain. You only receive $300, half of that amount, because it's split in half by the participation rate. So again, your gains are limited. So if you have a mutual fund, for example, that's getting 12%, well, you're losing out on 6% in interest because it's capped based on, one, the participation rate of the insurance company they said, and you're capped at the amount for the IUL. So you're losing out on gains, right? Now, here are 3 reasons why I recommend not getting an IUL. One, it's more expensive than term life insurance. Why? Because you have to pay fees. It's similar to a whole life insurance policy. Whole life insurance policies or permanent life insurance policies are more expensive because of the cash value component of it. So agents get more of a commission when they sell you an IUL and a whole life insurance policy, right? So that's why I recommend not getting an IUL, because it's more expensive. Now, the agent may tell you that, yeah, you have insurance for your whole life, but they're going to get more commission because you're going to have insurance for your whole life. Insurance is there to move risk from you to someone else, but you want to have insurance for your entire life. You want to hopefully self-insure by having investments that provide money for you in case something does happen. Right, so when you pay your premium for your insurance policy, basically a portion goes to the policy, a portion goes to your fees, and a portion goes to the cash value. So that increases the value of what you're paying for the policy. Number 2, why I don't like an IUL is because the cash value isn't paid to the beneficiary. That $10,000 I mentioned to you earlier about the cash value that's in the account, in our example, so you bought a policy for yourself for $1 million, right? IUL policy. $10,000 cash value saved up, all right? You pass away. Your beneficiary will only get the face value of it, the $1 million policy. They don't want to get the cash value. Who gets that? The insurance company does. So the cash value is there just to make the insurance company more money. Yeah, you can borrow against that $10,000, but what if you borrow the money, pass away, and you owe, say, two grand because of what you borrowed? Basically, the $2,000 is gonna come out of the face value. They're gonna deduct the $2,000 that you borrowed from the face amount. So your beneficiary will get less money than what the whole life policy has, which was $1 million. So again, the cash value that you're saving up for doesn't belong to the beneficiary, it belongs to the insurance company. That's why it's a bad buy, number 2. And the last reason I think you should not buy an IUL is because of the reason that you're trying to combine investing and insurance, right? The first part of that IUL, index. When you invest in the stock market. You can do an index fund, which basically tracks the stock market. And it basically reflects the value. If it goes up or goes down, it's going to track that particular stock market index, right? So it's attempting to be an investment. However, it's not an investment because it's whole life, rather universal life insurance, IUL. It's attempting to combine insurance and investing. Investing is meant, in my opinion, to be separate from insurance because investing is meant to grow your wealth. Insurance is meant to reduce risk. I'll say it again. Investing is meant for increasing in your wealth, growing over time, whether it be through stocks, bonds, mutual funds. It's going to grow your wealth over time, right? You're investing in a vehicle, an asset that's going to increase in value over time. Insurance reduces risk. So if I have life insurance, the policy is on me, but it's going to not protect me, it's going to give a cash benefit to my beneficiaries, my wife, my children, when I pass away. So it's going to replace my income because they're going to get this money, invest it in the stock market, and basically get, say, 10% return on their money. So they're going to get that, replacing my income through that particular vehicle. They're going to take the proceeds and invest it so that my income can be replaced so they can continue to have standard of life as if I was still alive. So again, taking the risk from them and putting it on the insurance company. That's why you should keep investing in insurance separate because they have two different things. Again, investing is for growth. Insurance is to reduce risk. That's simple. And the IUL is attempting to do both. It's attempting to create growth, right? Through the index part of it, getting interest in the cash value account. But the whole point is you're growing interest for the insurance company and not you or your beneficiary. That's why it's a bad buy. And secondly, it's attempting to be life insurance. Not any kind of life insurance, it's attempting to be a type of whole life insurance, which is more expensive than term life insurance. So that's why those are 3 reasons why I do not recommend buying an IUL. Whether you like this podcast episode or not, the whole point is make sure you get understanding before you buy life insurance. I recommend buying term life insurance if possible and stay away from IULs and whole life insurance. So I hope you enjoyed this conversation talking about IULs. Leave me comments. I know I'm gonna get hate comments on this one, so it doesn't matter. The whole point is the truth is out there. Don't buy into the lie that IULs are good. IULs are not investments. IULs are simply whole life insurance. That simple. So please comment, like, and don't forget to subscribe to the Coins, Cashflow, and Conversations podcast.